Great. Well, welcome everybody. Let's get rocking and rolling. It's 10 a.m. I always like to start on time to honor those of you who are on time. So thanks for being here. What is it, July 30th? We about wrapped up the hottest month of the year. It's definitely been a heated month. So hopefully you've had a fantastic summer. Those of you who have kids, I think we're 3 weeks away from putting kids back in school, getting part of our lives back, I guess. Well, let's get rolling. I want to introduce first my co-host, Mike Carmody. He's an agent, he's a broker, he's a pilot, he's a skier, he's a father, he's a husband. And last
Hmm.
year he won a big award, Utah State's Coolest Broker Award. What does that award mean to you, Mike?
That means that all the other KW brokers must not have been in the running on that, Johnny. So I'm happy to. I'll be your. I don't know if anybody's gonna get this, but I'll be your Ed McMahon for today, Johnny.
Awesome.
How's that?
How long have you been in the business, sir?
I recall. I think I got my license in November of 1996.
Great,
So
great.
I think that will be 30 years, which is sure doesn't feel that long. Most of that part time for a couple of years. And then moved in and been basically selling real estate as my sole gig for, I guess, call it maybe 28 years or so, and 2 years of a principal broker under my belt, a little over,
Great.
and still learning.
And
Awesome.
if anybody doesn't know his better half, she's the one that does all the work on the back end.
Absolutely. Yeah. Cleans
Great.
up my messes.
Well, awesome. Well, I'm glad you're here to co-host this. Totally appreciate your wisdom, your experience. You've seen quite a few shifts in your career as well, and just even shout out to all your South Valley peeps here supporting you. So, and
Thank
also,
you.
as always, like to introduce the man behind the curtain, our local resident economist, Gordon Payne, who makes this tremendously easy as he prepares this all quarter long, all the data sources, all 160 slides of data. And Gordon, I'd probably say 40% of the conversations you and I have are about the economy and the market. So you're one of my favorite people to talk to about that.
Thank you.
Well, as always, Gordon records this. He produces these slides. I just loved over the years seeing all these slides getting used in your buyer presentations, your seller presentations, even shared and whatnot with your database. So kwutah.com, you can find those quarterly market reports. And the quick little link, kwutah.tv, will take you to the YouTube channel where we record this. Kimber rewatches this usually 3, 4, 5 times a week, every quarter. So thank you for that. But let's jump in. The Federal Reserve's got a new chairman, as you know. Most of you watch the news. The Federal Reserve has a major impact just on setting rates and buying assets and selling assets, lowering rates, raising rates that definitely impact our world, specifically even the mortgage market. But Kevin Warsh is who took Jerome Powell, his position. As always, there's multiple board of governors, but the chair tends to be the voice, the stage presence person that will say one word, one sentence, and the market will shoot up or down depending on what they think that the Fed's going to do. But he's got, a decent amount of experience. He was a former member of the Federal Reserve Board of Governors back in 2006, special assistant to the president for economic policy under George Bush. But just even private sector academia, just a lot of wisdom in the financial world. But also, usually when that Fed chair comes in, sometimes they'll make some of their own changes. And one of the things that Ruben out of our Keller Williams research department was talking about with us a week or two ago is just the shift in Fed communications. I can't even read this. The Fed is scaling back the detailed guidance it traditionally gives the public, recently issuing a shorter statement and planning an overhaul of its future economic forecasts. This more opaque approach may increase volatility in bond markets as investors try and predict the Fed's stance, in turn, making mortgage rates more volatile as well. In short, they're just going to talk less. So we're going to have to probably predict a little bit. I think they really just want the market to let dictate the market versus the Fed always giving lengthy, future forecasts that could be right or could be wrong. But even just the potential interest rate hikes, the Fed committee that sets interest rates is currently split. In their last meeting, half of the members expected the Fed to raise interest rates at least once before the end of the year. And then even just no rate cuts in sight. Investors and financial markets currently see a 0% chance that the Fed will lower interest rates at any point. Even if you look at what Gary Keller sent out just yesterday, actually. This is just another way of looking at June 16th, 17th meeting that the Federal Reserve had. They only had one of the Board of Governors vote to do a rate cut. Eight of them voted no change, which the current range is that 3.5 to 3.75. And then three voted one increase, five voted two increases, and even one voted three increases. So again, we talked about this yesterday, Mike and Gordon. A lot of this just stems from the instability, the craziness that the Iran war is having on us, right? Even when we got into that thing, we were told it would be 1, 2, 3 weeks. It is for sure drug on. And if you watch the news at all, it has been very hard to see that we're going to be out of that quickly. It does seem like that's going to drag on. The chaos in oil has kind of ripple affected into things. So I think even if you tuned in like the first quarter or even the January one that we did, we were pretty optimistic that we were going to see quite a bit of gain just because of the pent up just demand and all the cool things happening. It feels like the Iran war has just kind of almost made everything feel like we did last year. Would you agree with that, you two?
Yeah, I would, Johnny. I think I mean, going into March this year, we were feeling pretty good. Rates had come down last fall, and then, you get the Iran thing happening, and then we've just got more volatility. So I think the rest of this year is going to feel like
Hmm.
18 months ago, you know?
Yeah, and with half of the Board of Governors voting this last meeting for increases, there's a very high likelihood we could see at least one increase in the federal rate, which no doubt could impact mortgage rates. So it's a pretty decent chance we might see mortgage rates a little higher by the end of the year than now, unless something miraculous happens, I guess. So let's just start going through our handful of slides. As always, we go through a little bit of just UAR, but really just the five main categories of the real estate market. We'll touch on investment properties, a little bit of commercial, just the general economy of the United States, and then Utah. But as always, we compare Utah with the nation, so you can kind of get a good perspective. And even the conversation me and Mike had yesterday, man, when you look at the state of Utah, there's so many when you zoom in to specific cities, even neighborhoods, it could be a totally different story from just a city over or a neighborhood over. So we will be covering Utah state slides. But as always, you got to dial into your local expert market because who knows, whether those are up or down. But NAR has been going backwards membership wise since what, 2021? So we're down about 142,000 agents or realtors just in the country. We were following that trend line for a little bit, but if you look at the last year, even we've turned back up. We're still floating around the all-time high of realtors in UAR, right around that, mid 19,000 realtors. But as you know, Mike, you're going through your list. Board dues usually are due in the summertime.
Yeah.
So I think we might have one of the bigger losses of agents just not paying their dues and kind of, getting out of the industry. So my guess would be this next quarter, we might see that turn down a little bit. I don't know your predictions on that, Mike, but
Yeah, I think so. And public service announcement, guys, make sure if you haven't paid your board dues, at least for Salt Lake Board by Friday, the late fee is $350. So get it taken care of. But yeah, I think with some of the challenges that we're seeing in the market, that it's expected that we may see that number continue to drop throughout the year,
yeah.
or second half of the year.
Which, I think even some of those are getting out of business had zero transactions anyways. But when you look at the sides per agent, more realtors, divided by the closings will give us our sides per agent. So I think even getting some agents out of the business will definitely just, give more of that fair share to our agents here on the
Yeah.
call and our KW family. So we'll see that trickle up, but still floating around, 4.6 sides per agent right there, UAR. So.
Yeah.
The best thing though, real estate, no doubt, Gordon, you've been creating a lot of great slides on here. These are just great ones to use in your marketing and your materials. But again, real estate remains America's number one long-term investment for 14 years running. So 38% from that Gallup 2026 poll still vote real estate as the best investment out there. And especially if you have any crypto that's tanked lately, you would definitely vote real estate still dead solid. And even Utah homeowners built nearly $289,000 more wealth than a comparable stock investment. So if you look at just Salt Lake City over a 10-year wealth comparison from stock gain versus home equity, 368,000 from home equity to stock gain of 79,000. So even specifically in the state of Utah, the last decade, with just how great of appreciation we've had. Anybody that owns anything has felt that. So definitely outperforming some of those investment vehicles. And even just, the growing barrier just to housing mobility nationwide is the capital gains lock-in. So one of the things Gordon and we've talked about is trying to raise that threshold of that exemption when you sell your owner-occupied home, just to be able to get that up so you don't pay capital gains tax. But Gordon, do you have any comments on this?
Well, I use myself as an example. I bought back in '05, and now my townhome is worth $600,000. It's not even a standalone home. I'm
Mhm.
locked in.
Yeah.
And it doesn't really take that amount of time to meet that. Unless you're married, then you've got the 500.
Yeah. So singles,
Yeah.
250,000 threshold. So if you gain 250,000 in appreciation over a 5, 10, 20-year period, anything over that will be taxed at capital gains route. And with how much prices have gone up and just appreciation, there is a very great case to try to get that raised a little bit for owner occupied homes.
Yeah.
Yeah.
And they haven't kept up with inflation with that. That I can't even remember. I think it was on there, but when they first put that in, they didn't put in inflation rises in that. So it's locked in back into the 1997.
Yeah, 30
Yeah.
years ago.
1997.
Yeah, when you got your
Yeah.
license.
Hopefully we'll see some movement on that. That would be nice.
Yeah,
And
they've been
Johnny, and a
talking about
couple of those previous slides are some that really comes to me as this long term, right? Real estate is, it's hard to lose money, in that 10-year time period with real estate. So in talking with clients, these would be a couple slides that I would share as to, we have some volatility right now, but point is for buyers is get in. If you can get in, get in.
Mhm.
And, don't be thinking about 24 months from now. Help the client get focused on this is, long-term wealth. So
Yeah.
I like those slides. Just keep showing that real estate is the best investment.
And as people are sitting on those low rates, the low mortgage rates, maybe even some have their homes paid off, but the tenure staying in one home is getting longer and longer and longer. You know, 2 decades ago, 1985, 2008, the average tenure that someone would stay in a home was 6 years. It's floated all the way up to 9.3 years on average, which I do think all of a sudden having a 3% going up to a 6.5% rate, that is one of the major impacts out there. But definitely even markets, there's cities that are 12, 15, 18 years tenure on average in certain cities.
Mhm.
But let's just take a look at the whole snapshot. And again, some of these numbers have softened a little bit from even last quarter as the market's kind of almost, somewhat flatlining in a lot of these categories. But if you look at listings from just where we've gone the first 6 months of this year compared to the first 6 months of last year, we're only up 1.9%. We started out a little bit hotter with more listings coming on the market. It's kind of cooled off a little bit, but up 1.9%. But when you look at pending sales, only up 0.9%. So almost flatline on under contracts, 22,800. Closed sales, 2.8% above. So we were really hoping as rates went down, we were hoping that we might see anywhere from 5 to 10% increase in closed sales. Even in the country being around that 4.1 million homes sold in a year, we were hoping to start seeing they get up to 4.5, even journey all the way up to 5. And until we see, a little bit more reprieve on the mortgage rates, it does seem hard to see a big jump in closed units. But you see even 2.8% is still moving in the right direction. And even just the inventory, days on market, inventory of homes, all those have kind of trickled up a little bit, with days on market being up 8.1% at 67 days across the state. But again, just with the lack of supply out there, still is what's kind of holding our prices solid, even with some minor appreciation. But so far, we're at 2.6% median sales price increase. So appreciation there. And we'll show you some projections from some of the main sources out there. But even percent of original list price, we're pretty much flatline, down 0.3%. So when you list a home, the average home sells for about 96.6% right now. Housing affordability has just stayed consistent so far compared to last year. We saw mortgage rates come down a little bit, over the last 12 months, but then we also saw appreciation going up. So that's why affordability is kind of flatlined. The challenge is if we see a little bit more appreciation the last half or even the next 12 months, and if we do see the Feds raising rates that impact mortgage rates going up a little bit, we're going to see affordability go backwards, which again, the affordability category is the most quoted headline out there as newspapers and all that
Mhm.
as we've continued to try to battle that. And then we got inventory of homes for sale up 4%, and then just months of supply. So, Mike, I know we're going to go through all these categories, but any initial insight on this snapshot?
Like we talked about, and I think we're going to go into it a little deeper. I'm looking at it as an agent that's still selling real estate, and I look at, median sales price up 2.6%, right? And I'm like, here's everything I've been dealing with is dropping.
Hmm.
And that's where I think you had touched on in the beginning is really when I'm looking for a particular seller, uh, really being hyper local, right? Obviously, we're doing CMAs, really just, the difference between Daybreak and Sandy and, Vineyard. You're going to have quite a bit of difference. So I'm kind of cautious to, say to my clients, well, our median sales price went up. This is looking at the whole state on average, 2.6. And
Hmm.
so I think we're going to talk a little bit more about that.
Yeah, I think you're right. And I even had a conversation with my partner, Clay Winder, yesterday. Just, even some of these the townhome complexes, it just seems like they really have depreciated. There's several
Yeah.
investment condos that, 2, 3 years ago, they were worth 50, $60,000 more than what they're selling now.
Yeah.
So, like, to say that Utah's appreciated, it is hard when you zoom in on some of those specific neighborhoods or markets, whatever. It feels generally like prices should be a little backwards, but technically, the stat and the data shows that they're not overall. But me and
Mhm.
you, Gordon, all of you on the call that are Keller Williams, I love bragging on our group here in KW Utah, our 1,500 agents strong. We are dramatically outpacing the market. So again, the listings have only been up 1.9, pending sales up zero point 0.9, and then closed sales up 2.8. You see underneath those numbers on the right, that's actually what KW Utah is up. So clear on the left, that's how much we're outpacing the market. So our agents, Keller Williams agents, are taking 17.3% more listings than the rest of the market. They're putting more under contracts and again, up 10.6% more in closing. So again, I think we've got a great group of people. So just celebrate and high five to all you that are crushing it out there. But let's jump into these categories. We'll start with home sales. So U.S. existing home sales. 23, 2024, 2025, just right there, flatline. 4.1 million homes sold, existing homes sold in the country every year. We thought we'd see those go up or down a little bit. And again, every projection we looked at last year, even Gary Keller up on stage, we thought we would be outpacing 4.1, by a decent margin, 4.3, 4.4. But look at that. Like in the country, we're backwards. We've actually sold a little less existing homes as just those mortgage rates and just the economy in general have kind of just been pretty steady, I guess, versus improving to the point that we need more closings. Here's just the month to month existing home sales. And then even just overall, just throwing a bunch of data on here, you can kind of just see, historical averages. Anything on this, Gordon?
And not seasonally adjusted. It kind of shows how far we are off from the high, from the historical average.
Yeah, even just this on the far right, the actual numbers, not annualized, you just see the historical average. We should be selling more houses,
Yeah.
right? Here's the
Mhm.
new homes sold. Our builder business and the percent of the marketplace they're at. We see a lot of builders, throughout the state of Utah, but annual new homes sold, we're down in the country 4.9%. So right around that 626,000 new homes coming on the market. Average is 696,000. So again, we want to build more homes, but again, costs. Land costs are still high, government costs, red tape, fees, impact fees, the length that it takes, to get homes approved and subdivisions and developments approved. You think about just all the expense that goes in. Labor costs are up, construction supplies are up, building materials are up. So again, we want to build more homes, but we've got to figure out how to get those down a little bit to start building those at a higher pace. So.
Mhm.
And then Utah, again, we went over those numbers, but you can just see where we're at. Annual homes sold per year, pacing a little bit ahead of where we were last year. So we should end the year maybe what, around 44,000 homes sold.
Hopefully.
But looking into the future, if we had our crystal ball here, here is the sources out there of what they think the home price increases in the country will be by the end of the year. We love NAR. They're always the most optimistic number that comes in. They're saying 4% appreciation in the country. Fannie Mae saying 3.2%, Wells Fargo 1.9%, and then 1.7 from the HPES, and then Mortgage Bankers Association 0.6%. So even if you took out NARs, we're probably floating somewhere around the 1.5-ish percent. MBA, the mortgage bankers tend to be some of the more conservative out there. All still show price gains, but just not at a huge ratio there. But again, Utah is outpacing the appreciation of the country right now. So if you look at home prices in the U.S. are only up 0.8%. So even if we were to end around 1.5, it'd pretty much just be doubling what we did already so far this year. Again, 50-year average, 4% appreciation is usually what we're at. 36-year average on here is 4.37, so well under that 4% appreciation. So I think in income, a lot of that's just trying to catch up. That's going to help affordability, but when we start seeing mortgage rates turn down again, that we'll start seeing that pop up a little bit.
Yeah.
415 median price across the country, 415,000.
And luckily, we're that trend line is compressing nationwide, not in Utah, but
Yeah.
that's starting to compress a little bit now.
Which Gary Keller would always talk about this. Like we almost felt like we need to reset that line after the recession, but we caught up, we passed it, and now we're kind of we're letting that line catch up to us again. So it's really, probably in my opinion, Gordon, a positive sign. Like it's a
Yeah,
really
oh,
healthy
very
spot
positive.
to be in just to follow that line versus
Yeah.
being so far above or below.
And when we get to
Right.
the Utah numbers, we're not doing that, unfortunately.
Mhm. U.S. median home payment principal and interest. So if you put 20% down, bought a median purchase price home in the country, what would your principal and interest payment be? Right now, as of June 2026, end of June, $2,226 would be your mortgage payment. Definitely not in 2020, 2019 eras anymore. We are above that, but there's our median payment. And here's just kind of looking at home price appreciation or depreciation as we've gone through all different cycles. So this is pretty much the entire career of Mike. You said 54 is when you got your real estate license?
56.
Okay. But you saw what? You saw the housing bubble. You saw the Great Recession. You
Hmm.
saw the craziness of the pandemic. You saw the Fed, dropping rates, lowering rates. But again, just even being around that consistent, 4% appreciation is a healthy time period. But we've been
Yeah,
through some crazy swings.
absolutely.
Here's Utah home price appreciation. It just feels like we're kind of recovering still from the COVID boom. Look at 2020, up 11.6% appreciation in 1 year. 2021 was bonkers, Mike. You remember that time period very clearly.
Yeah.
25% appreciation in one dang year. And then 2023, we finally had to recoup some of that crazy appreciation. That's when prices went down. And then really just kind of been slow but steady, the last 3 years, which I think is a healthy spot to be on affordability catch up.
Hmm.
So here's what you were talking about, Mike. Zooming in on just the counties real quick, because like we said, it feels almost contradictory to feel like the whole state's appreciating, but you can zoom in on your county. Some of these counties are really small. They only had one, two, five, transactions that can kind of swing the numbers a little bit. But you look at some of our major ones, Washington County, pretty much flatlined, only up 0.2%. Utah County actually is up 5%. So Utah County is driving some of that growth, especially when they have just what, 900,000-ish transactions per month. You look at Summit County, our Park City folk up there, fantastic purchase price, but they're actually down 11.2%. We've seen that market. Michelle gave us a little bit of rundown on our last leadership meeting that just some of those luxury listings are sitting, a little bit longer. It's taking a little bit more effort to sell it, just like most of the rest of the market. You look at Salt Lake County up 3.1%. Davis County, 0.2%. You got Weber County, 0.6%. Any of these other counties. Cache County, all of our Logan agents up there, up 4.2%. So you can kind of just see what counties are helping, which ones are slowing us down. And then home prices, again, 518,000 is the median price right now. But if we were to layer that same trend line at the start, like we did over the nation, we are way above the trend line. We were very under the nation's average price, 20 years ago. We've definitely caught up and surpassed that. But 518,000 median price right now.
And that's above, that's our new high above trend
Yeah.
this year.
Yeah.
hmm and then home prices by month. Kind of just see how home prices overlaid with that orange interest rate. Earlier in this year, those lower 6% rates were helping kind of fuel the market a little bit, but we've seen that go up, right around 6.5. The 20% down payment, the median home payment, if you bought a median purchase price home in Utah with 20% down with a median interest rate, mortgage interest rate, what would your payment be? It'd be 2,657. So again, that's where a lot of just buyers sitting on the fence, not buying, just until we figure out how to get that payment down a little bit. But if you overlay the nation with Utah, you can just see where we start separating. Right around 2016 is Utah just started throwing some jet fuel on our economy. Just all the net migration, the great businesses coming in, just, our prices took off. So Utah income needed to afford a median priced home. If you look at just from 2024, your income had to have gone up 4.9% to afford a median income. So if you look at median purchase price, 526,000 with the average interest rate of 6.5%. Income needed to afford a median priced home would be 153,000 household income. And what percent of the income's going to your payment or to afford the house, Gordon? Was it 20%?
No more than 30.
No more 30% of the
Yeah.
income. Okay. Okay. And Mike, you got any young adults having to move back in with you? Your kids wanting to move back in with you? Because that continues to go up. We are at record highs. And
Give it
then
a year.
give it a year. So the preliminary estimate is 17.9% of young adults from 25 to 34 are coming home to hang out with grandma, grandpa, or mom and dad. Record high. So the low you see even just the last 3 decades was 10% back in 2002. Right there, the average 13.6. So clearly that. And then also, this one's a crazy stat, millennials. Millennial demographic, out of all demographics, is the highest percent of buyers traditionally above everybody, but it has swung up and down like crazy the last several years. We peaked in 2021 with 43% of homes that were bought were the millennial generation, swung down, swung up, but we now are back down to 26%. Which is really, really low. And then the other thing that's happening, which, all these add up to just the first time home buyer average age is getting older and older and older. So right now in 2013, it was 31 years old was the average age of a buyer. It is 40 now. The average first time home buyer is 40, which is crazy.
We discussed that yesterday. The Gen Xers, my generation, we're such a small generation, we're not making a dent. Whereas the
Right.
millennials are what, triple us?
Yeah. Yeah.
Yeah. Yeah. And Johnny, I think on that one, where we talk about the kids uh living with, coming back living with parents and grandparents, one of the things we can do as agents is help guide people. Now that this business might be a couple of years down the road, but if I get a daughter come back from school in December and want to stay at home and try to keep costs down on that, I know this business. I can help her say, why don't you save up some money, and let's put a plan together within 24 months to see if you come up with enough down payment, keep your debt in check.
Mhm.
And I think they need to hear it, because if they're just listening to the news or early 20s, mid 20s, they're just hearing that they can't buy and everything's expensive. And we
Yeah.
can look through this data and realize, yeah, there's always a way, but help them plan as agents, brokers. I know you guys know this, is just, consult with them, talk to a good mortgage lender, help them put on a plan that, 36 months, 24 months down the road, they can actually be going out. Obviously, we can help them buy a place, right? And
Mhm.
use what we know about debt,
Yeah.
avoiding debt. Don't buy the new car. If you're going to live at home for me and pay nominal rent or not pay any rent, you're not buying a new car. You're going to be, you know, paying me $700 a month to live in the basement, but I'm just going to put that in an account pretty quickly. You got enough for a down payment. So
Yeah.
just some
Yeah.
thoughts on that.
Yeah, and we keep hearing about just the trillions of dollars that are going to have to be passed down from the baby boomer generation down to Gen X and specifically the millennial generation. So we're starting to see that finally open up a little bit. We even have a community inside of KW called the KW Planner Community that actually kind of assists, some of the elder generations just on, strategy and passing down things. But I do think we're seeing a trend instead of just waiting to, a death that inheritance passes on that, they're trying to help some of these millennial generations get into
Mhm.
purchases earlier on and having a wise consultant, wealth advisor type of mindset as an agent to go in and kind of help facilitate that is definitely a great strategy right now.
Absolutely.
So homeowner rate comparison, Utah still does better on percent of our population that owns homes. We're at 68%. We have came down from our top high back in 2008 of 76%. The gap's closed a little bit with the nation being at 65%, us being at 68%. But then also, when you talk about inventory, everybody knows it's kind of like increased, right? So we across the nation have 4.3 months of inventory. Utah's a little bit lower. But Mike, we talked about this. We always say the balanced market is 6 months. Anything above 6 months is a buyer's market. Anything below 6 months is a seller's market. It feels like a buyer's market, right?
Yeah. Yeah, it definitely does. I know talking about that, that's been a rule of thumb that's for the time I've been in real estate was, looking at it, how do sellers and buyers talk about, well, it's a buyer's market, it's a seller's market. What does that mean? And we always said, if we got 6 months of inventory, advantage to the buyer, anything less, advantage to seller. Now they're telling us we're 4.3. But I'm speaking from my experience and a lot of my agents here that have conversations with is I think buyers got a lot of choices. I think the buyers have the negotiating advantage in this market. And so maybe that balanced market of 6 months needs to change, but we're dealing again hyper local. What we're dealing with right now, I think advantage buyer, and so my conversation is great. It's a great time to buy. You have more choices. We can probably have a little more negotiating power and take advantage of it. So if you're buyer heavy right now, great.
Yeah.
Still always encourage you to get good priced listings, but some of my focus in talking with my sphere of influence is buy. There's choices. For those of you that remember how it was in 2021 with a buyer.
Hmm.
I think what we have on any given day, we had like 400 single family homes listed in Salt Lake County. That,
Yeah.
that, that was great as a listing agent, but as a buyer's agent, it was tough. So right now, I think it's just focus, be okay focusing on buyers, good
Yeah, I didn't.
opportunities.
Back even post recession, the high inventory, 10, 9, 8 months of inventory. I didn't like that market. And then when we were below 3 months of inventory, I didn't like that market either. Like I
Yeah.
do feel like my sweet spot or what I enjoy the most is 3 to 6 months. I think right where we're at is great.
Yeah, yeah. If you go back to that in 2008 through 2011, Johnny, when there was just so much inventory, you had a buyer on that. It was like you found a house you liked, and then 24 hours later, another house, the same house came on for $5,000 less, and you were showing so many houses. There was just so much inventory. Obviously, polar opposite with COVID. So, I like this. I mean, we're a fairly balanced market, right? Buyers market, sellers market, right? But it is just that's one thing that I've seen this type of market over the years, and
Mhm.
think we'd like to see rates a little better, but this is
Yeah.
a decent market at the end of the day.
Well, even pending home sales index right on line with the last couple years in the nation, but it is nice to be in a market that you just don't see the big swings up or down because it
Yeah,
helps you have a little bit more of a predictive career path. It's easier to communicate with sellers and buyers what the market's doing. When the market's moving like overnight, it's definitely burdensome.
challenging.
Hmm. So here is U.S. new single-family housing units completed, a little lower than where we were last year. 55-year average is right around that 12, which is 1.2 million homes. So we're under that. We still need to be completing a few more homes out there. If you look at just even some of those same data points, Utah, inventory's gone up, days on market's gone up, but it's not as extreme as the US, but still up 4.1 months of inventory, just barely up 0.4%. So it feels a lot like where we were last year. Same kind of just trajectory every single month if you zoom up on the months. But you see the new listings so far year to date. We've had 35,800 sellers raise their hand, put their home on the market so far this year, up 1.92%, which again, double that number for the last half of the year. Will be pretty much on pace with where we were last year with a little bit of improvement. Seasonality wise, you can kind of just see a lot of the same with just that teal and the red lines. Percent of new listings sold, we saw that trickle up a little bit. So last year we averaged 63.15%. So almost, two-thirds of every home that went on the market sold. We're now up to 73% of percent of new residential listings sold.
And I think that has a lot to do with the interest rates that at the beginning part of the year, everybody was like, okay, unlock, let's go.
Yeah.
Yeah.
And now we've kind of slowed down after that first quarter.
Yeah. So if rates stay where they're at or even trickle up a little bit, we're going to see this probably go down
Yeah.
and fill like last year as well, which means, days on market, inventory, all that might just trickle up a little bit just to get that back down to two-thirds. Inventory of homes for sale, 41,000 homes for sale, up 4% here in Utah. Just look at almost every month when we go to these month-to-month slides, Gordon. They almost feel so identical to the first half
Yeah.
of last year.
It's just flat across the board.
hmm Pending sales 0.94 up, but 22,800 pending sales. US average days on market 37.2. Average days on market that doesn't include under contract time period, but up 10.4%. So just added another 3, 4 days on market. Utah average days on market does include the under contract period, so up 8%, 67 days. Just floating a little bit higher than that 15-year average. Average interest rates again. Last quarter, Gordon, we and our guests talked a lot about just perspective, of when you look at the whole, history of the market, all that. 1990 to 2023, the average mortgage rate across that time period, even when we lived in that low interest rate environment for so long, average still 6%. If you look at the last 50 years, we're talking 7.72. So pretty much the whole first part of the year, we've been hovering around that 34-year average and sometimes reminding, perspective when you're talking to your buyers and sellers. This is just usually a great chart. For us to think that we're going to journey back to 3% interest rates anytime in the near future seem hard to believe, right? Here is just weekly, we saw 23 kind of peaked out of the 7.62, still a lot better than that 7 point mid sevens. But the low point again this year was at 6.05. I heard of some 5.99s out there without using incentives, but now we're trickled back up to kind of 6.5. But even builders, we're still seeing a lot of incentives, a lot of builders throwing money at just trying to buy that rate down.
Yeah.
Weekly interest rate, here's your 15-year, still right around a half to maybe 0.75% gap between the 15-year and 30-year traditionally, but even at 15 years floating right under 6% interest rates. Gordon created this. This is great, Gordon, because oil has, when oil, all the chaos of the Strait of Hormuz, the Iran war, all that, the number one catalyst was oil prices. What did it do to fuel and gas and all that stuff? And how does that affect our market? And there is some correlation. So if you just overlay straight up mortgage rates with oil prices, there is some correlation, but traditionally oil goes up. Oil is just the most common thing in everything. Food, transportation costs. You talk about jet fuel. You talk about us going on vacations. Like fuel going up just raises prices everywhere. That's why we've seen inflation go back up. But then inflation, as soon as inflation starts going up, that's when the Fed starts panicking, and then the Fed wants to raise the federal rates, and then federal rates go up, and then mortgage rates usually are the last domino that start trickling up. So if you see, some of the time periods where oil went up first, then mortgage rates lag, but then there's just other weird times like even 2022, mortgage rates went up and then oil rates followed, but a lot of that had to do with the war, the Russia-Ukraine spike. So is there correlation? Yes, but not always totally the same. Here's your treasury yield. So if you don't pay attention to the 10-year treasury, that's usually the best predictor of where mortgage rates are. So the 10-year treasury yield, you see right there, pretty much exact movement over the last decade. When treasury moves, mortgage rates move. But then the gap between treasury yields and then the mortgage rates, a lot of times that just has to do with mortgage companies calculating their risk on giving people money. Are they going to get it back, right? So right now there's a 2.11% gap from treasury to mortgage rates. At the high point, 2022, 2023, when inflation was crazy, you start seeing that getting almost 3% gap. The lowest we see is 1.9, 1.78. So, still pretty healthy gap, I guess, but we'll see what that does. But here's your 30-year fixed rate mortgage. Even though Fed rates have stayed consistent pretty much all year, we've seen that mortgage rates go up, 30, 45 basis points. But then
Mhm.
even we saw this go down. This is the national mortgage rates. So 66.7% of mortgage rates of 5% or less. So this is saying two-thirds of all mortgages out there are 5% mortgage rate or less. You see 19.4% is 3% or lower, 3 to 4% is 30% of mortgages. So you can kind of just see the makeup of where mortgage rates are. But we've seen this go backwards, what, 5, 10% over the last couple years, Gordon. But
Yep.
even Utah somehow is just a little stickier. 80% of mortgages in the state of Utah are at a mortgage rate of 5% or less.
Yeah, and that number is a year old now because the University of Utah hasn't released the slides yet. So I'm really curious when they do if ours kind of comes down a little bit.
I would guess it has, right? With
Me
just
too.
volume purchases, refinances going up.
Yeah.
Um, But peering behind the curtains on the Federal Reserve, they have that rate that they move up and down, but they're also usually buying or selling mortgage-backed securities or just assets in general. But if you look at the last 3, 4 years, they've sold over almost $1 trillion of the mortgage-backed securities. And Gordon and I always talk about this. When you start seeing the Federal Reserve selling those assets versus buying, normally you might see the credit market kind of shrinking just due to the available capital out there with banks. We haven't seen that yet. We haven't seen a credit really tightening. We don't totally know why. It could be maybe because some of the profitability of banks are up, which is increasing some of their lending capacity. But overall, credit is still pretty available out there. They have started buying some other assets over the last several months that start trickling up, but not necessarily mortgage-backed securities, but we'll see how that goes. Here's the MBA, the Mortgage Bankers Purchase Index. So this is how they kind of track all mortgage applications that come in for single-family home purchases, whether it's conventional or government loans. You're starting to see that go up. Their low point was 2024, but they're up 8.5% on mortgage applications, which a lot of times can be a predictor of future home sales as they're
Mhm.
getting mortgages. So that's usually a pretty positive sign. Hasn't shown up necessarily in our home purchases going up, but hopefully that's a precursor. Here is just a weekly look at that. Just kind of slow and steady increases if you kind of average that out. But here's that credit availability. So not only has it not gone down, it's gone up a little bit. So there's even a little bit more mortgage credit availability. Still giving out really healthy mortgages, kind of on a month basis. But here's the refinance index. So this is one that our mortgage people love, just making sure that's going up. Their low point was 2023. Everybody had a low rate. So when rates all of a sudden shot up, nobody wanted to refinance. But look at even just the last 3 years, it's going up. So we're seeing more refinances. There was the heyday that almost every other loan or mortgage that a mortgage officer was doing was a refinance. And then the other
Yeah.
half was purchases. It went maybe to 1 out of 10, 1 out of 15, but we're starting to see that go up quite a bit. So up
And I
65.
think that's going to slow down for the second half of the year because that first
Mhm.
quarter we had a ton of activity because the rates dropped so far.
Yep. Even that
Yeah.
50 basis point reduction in mortgage rates over the 3-year period helped refinances. So we see mortgage rates go up. Yeah, I bet we see that slow down. And here's just the overlay to mortgage applications with that fixed interest rate, purple. But foreclosures, we talked about this yesterday, Mike. In
Mhm.
comparison to the Great Recession, it is a blip on the radar. But But the percent of increase of foreclosure activity, those percentages are a little, a little scary. Up total filings
Yeah.
up 14%, starts, bank repossessions. Any comments on foreclosure activity, Mike?
Yeah, I think we're gonna, people are talking about it. We're seeing more short sales, for those that have bought in the past 4 years, since say May of 2022. And they did an FHA or Utah Housing, which at the end of the day, pretty much 100% financing. Those people are underwater. Um, I don't think we're going to see, a huge, certainly not going to be a huge foreclosure wave. Nothing like we saw, in 2008. But recommendation to agents is get familiar with the basics of a short sale so you can engage your clients with that to see about helping them out with it. I'm seeing more agents working on Utah Housing, which seems to be on top of and working with people to get these short sales so they don't have to finish the foreclosure process. If you have relationships with particular banks, probably not a bad time to just check in and see if they need any help, if they're going to end up with any REO inventory. So it doesn't surprise me it's increasing. I think over the next year or two, we're probably going to see it. Short sales, number one, I think will just become more common. You may start to see a few more HUD homes, possibly even some Fannie Freddie bank owned,
Mm-hmm.
some REO stuff. But
Yeah, and
get educated on it.
I'm starting to see more trainings on our market center training calendars for short sales and some
Hmm.
panels on this, but especially interview agents that are on this call right now that were in the business back then in the post-recession time periods. Like get on a panel, share some of your thoughts in team meeting because that wisdom is very valuable just to people that have never gone through
Yeah.
those scenarios. So
Yeah, one thing you mentioned yesterday, just like what's happening in the commercial market, the banks are doing the extend and pretend as well. So
yeah.
those numbers are kind of skewed, so they could actually be larger if we weren't doing that.
Yeah, people that are behind on payments, traditionally, back then they would have probably just started the foreclosure processes, the notice of default processes and stuff. Now they're kind of just kicking some of those missed payments to the end of their loan and almost
Yeah.
giving them some forgiveness right now. So yeah, I would bet these numbers are higher had that not happened as much. So you built this. This shocked me, Gordon. I didn't know we had so many homes in the country owned free and clear. So, roughly we have about 100 million homes in the United States. 38%, 33.3 million of those homes are owned free and clear. And then you've got about 33% of those 29 million that have at least 50% equity. So again, we have, what is that, 60, 75% of homes are either paid off or have 50% of equity. We only have 25% of homes that have less than 50% equity. So interesting, very interesting.
Well,
Hmm.
and toward the end of the slides, you're going to see some of the defaults that they track at the Fed, and home equity line and mortgages just flatline because it's cheaper for them to stay in it instead of renting.
Mm-hmm. Mm-hmm. And again, 90 million owner-occupied homes. That's just owner-occupied. So the
Yeah.
quantity of rental real estate out there, but $30.3 trillion total homeowner equity in the United States. Huge number. Average equity gain per homeowner since 2020 is 305,000. Only 3.3% of homes with a mortgage are underwater. So still historically low. But 84.5% of mortgages are current on payments, still the highest rate in 20 years. 1.2% serious delinquent mortgages, 90 plus days. So affordability year to date, actually in the nation's gone up a little bit just because we had that first chunk of mortgage rates being a little better. I'm assuming we'll start seeing this in the country go down a little bit too, kind of flatlining. But then you look at Utah affordability, exactly flatline, basically 0%, but 78, which again, we could see this go down a little bit if mortgage rates trickle up. Um, Before we jump into investment, anything closing out kind of general market, Gordon or Mike?
Just the same that we've had over the last 15 months. And it's not a panic situation. It's just a slow go.
Just go to
Yeah.
work. Yeah.
Yeah. Yeah. Stability. I mean, it's
Yeah.
up a little bit, down a little bit, but no major changes. I think that's, how I communicate to my clients, or, we call them challenges in the market. Rates are being hot, but we've got a good, solid, stable market. And I think it's going to be until we see major movement in interest rates, which I think you don't think we're going to be at 3% by December, Johnny? Yeah. How many of your clients? I mean, I talk with people. I'm going to wait for, rates to drop, but I can use all those slides. I'm probably not going to sit down with a client and go through them all, but as an agent, I want to have a good understanding of it. And if I come out of that, it's like, folks, we're in a pretty stable market, and I can have a good discussion with them. If somebody needs to sell their house, we all know about pricing, right? You've got to be able to price it right. Buyers, we want to consult them. If you can't buy now, consult with them, put them on a plan with a lender to where 24 months from now you've got a bunch of business coming in. So I like the stability of it. I wish we could see a little bit better rates, but it'll come. It'll come.
Yeah.
Give it time.
Yeah, it's almost refreshing, but it also feels weird to have such a stable, kind of consistent market the last little bit, because
Yeah.
anybody that's been in the business 6, 7 years, like we went from COVID times, like thinking the world was coming to the end, that we were going to go into depression, to all of a sudden it transitioning to the best real estate market that we've ever seen, to transition to the fastest moving real estate market we've ever seen, and then the sticker shock of just how fast they raised mortgage rates and just everything
Yeah.
slowing down. Like it's almost like weird to feel calm and just chill as a market right now.
Yeah.
Yeah.
Absolutely. Couldn't have said it any better. It's nice.
Yeah. So, who owns all the single family rentals? You see this again, 80% of all the single family rentals out there are just mom and pop investors that own anywhere from 1 to 9. There was that bill that was just passed that started touching on some institutional investors and banning institutional investors, from purchasing more single family homes. You should look into some of the details on that, but that is just trying to protect, either the mom and pop investors, but also just people owning owner occupied homes.
And from my understanding, they kind of left out the build to own though,
Yeah. It didn't
or
restrict
build
it.
to rent.
It didn't restrict institutional investors as much as the headlines made it sound. Yeah.
Yeah.
Overall, statewide rent, if you look at just quarter two this year to quarter two last year, statewide rent actually went down 1%. So statewide average rents, 1,808. Highest rent still up there in Summit County at 2,699. The median days on market for a rental, so those vacant rentals sitting out there, 28 days. Lowest rent out there in Duchesne, just kidding, Duchesne, 1,087. And then highest year-over-year growth of active rentals, 12.1%. You kind of just zoom in on your county. I got a lot of rentals in Utah County, up 6.1% just on the asking rent. I get those emails from my property manager as renewals are all happening. I felt like half of them were all, hey, well, let's just keep the same rent, renew the contract. Half of them were like, let's bump it up $50, which is a little different than even just 2 years ago, 3 years ago. Every one of those emails like, hey, we need to reduce it $50. We need to reduce it $100, where rents were kind of coming down, which was really hard on our investors, let alone HOAs going up, all that other stuff. But here's your rental rates, at a glance, what they were doing. You saw us just cruising up, same time period of, prices cruising up, rental rates were cruising up 2021, 2022, 2023, but then 2024 kind of just started slowing down. We went backwards 25 and kind of just right there flatlined on the averages from quarter two. You've sold a couple rentals, Gordon, but you're still a big landlord out there. Any insights on these? Anything else you'd like to mention?
It also goes back to areas. I mean, if it's a reasonably priced one, it's off the market in days. And some of these higher priced ones, they're taking, 30 days to get rented.
Yeah, yep. So with active rentals, so we got 7,021 active rentals, which compared to last year's quarter two, we're up 12%. So that many more rentals are coming on the market.
Yeah.
I wonder if that's a correlation with the increase of those people moving back in with mom and dad, right?
Yeah.
Vacating some of the rentals.
Mhm.
Here is just HUD, the federal housing assistant. HUD always sets, per county, per bedroom count, just what their assistant programs will dictate. Sometimes they're on par. A lot of times they're usually under market rent, current data. But you see Salt Lake City average rent. This is a great source that we have. But HUD right there is kind of nailed it at least this year. Normally they're way behind a year or two, but
Yeah, and the HUD numbers generally are from 2 years ago. So it's interesting to me to find or to watch Salt Lake City rents just in general start coming down.
yeah. And I know everybody's been getting their property tax notices too. Last year I felt like every one of my rentals had a property tax increase. I just got all my letters, and for the most part, every one of them's the exact same. I had a handful that actually came down on the assessed value, which finally is a nice piece. The
Yeah.
Utah housing profile, some key facts just on Utah's rental market. We have 61,000 or 17% of renter households that are extremely low income. So, kind of where that dictates, we have 44,000 shortage of affordable rental homes. I know there's just a lot of things going through, the state legislature, a lot of programs. We got a lot of great realtors that serve on the legislative committees and just a lot of charities that are trying to figure out how do we get more affordable rentals out there. You're seeing some federal government assistance. Average income limit for a four-person extremely low income, that's that 32,000 number. So, average rent growth, kind of see just the nation, 3 years in a row of just slight rent decrease across the country. But again, depending on what sector, like the Northeast seems to be hot. Some of the West or even South, Austin, Texas is getting hit pretty hard. They overbuilt quite a bit. But you can kind of just see some of these overlaid numbers, just kind of consistent the last 2 years in the United States. U.S. new build for rent, rental vacancies, all units. You see the United States up just a little bit on vacancies. But let's jump in just to the U.S. economy, which that's what makes the news articles all around the country. I get a Wall Street Journal notification on my phone probably 4 times a day on something going on. But if you just look at GDP, somehow we're kind of just consistent on our GDP. We normally like to see this number around 2, maybe 3%, but 2.1%. Kind of been hovering, just slow, steady growth. But again, what percent of that is just a lot of the money going into data centers and AI, those investments? Had those not been made, I think we'd probably be showing some negative GDP numbers. And Gordon, we always talk about this unemployment, how kind of solid unemployment still stayed. This is another one that just don't really feel like that. I feel like I've talked to a lot of people that are looking for a job or a career change, but still very low unemployment. Pretty much anything under 5% is just very healthy unemployment numbers, but it has trickled up the last 2 years, 3 years.
Mhm.
Job openings, again, we had a tremendous amount of job openings 3 years ago. We've started seeing that come down. Those lines have crossed over of unemployed or job openings. But if somehow job openings and those unemployment, we could just connect those two, we'd have 0% unemployment.
Mhm.
Um,
This one kind of shocked me what's happened in the West.
Just tremendous amount of job openings. Just a lot of the what business growth is happening in the
Yeah.
West, I guess, Gordon. Maybe a lot of relocations. Here's the real unemployment number, the U6 versus U3. Just U6 includes underemployed, so it could be some part-time that want full-time, marginally attached, discouragement. But labor force participation always usually consistent, right around the mid 60%. Utah's always outpaced by about 5%, so 66.9% of our population's in the workforce. And even just demographic wise, 25 to 54 always makes up clearly the labor force. But you created this new one. This is historical annual jobs added, Gordon. So quarter two in the country, 334,000 jobs were added. Any insights on this?
As we get to some of the other slides, that's where I think the the replacement jobs is affecting all of this and our unemployment, where they're kind of, I don't want to say playing with the numbers too much, but it makes a little bit more sense why our unemployment rate is down.
Yep. Yep. Labor
This
market
one,
workers. Yep. So current break even month, 30,000 jobs per month. So we basically need to create 30,000 jobs a month to kind of break even on the unemployment numbers, right?
right? And you see it back in 23 to 25. I mean, I think this is the direct correlation of why we're not seeing the unemployment rate rise.
Yeah. Yeah. Here's the sector, just the sectors of where employment's growing versus shrinking. But healthcare and social assistance, tremendous growth, quarter two year over year. Government shrinking. And then real wages. So this is overall wages, but weighted against inflation. So even 2021 and 2022, wages actually incomes went up, but because inflation was going up so much, real wages, your purchasing power, like how far your paycheck goes, was shrinking. But here we're barely up, pretty much flatlined on real wages in the country. And then even just let's talk about inflation, which this was the major headline back in 2022 as inflation was just skyrocketing. The government just poured tremendous amounts of money post COVID, set inflation out of whack. We really have done a great job at getting that under control. If you look at even 25, 24, we just started seeing very solid, consistent inflation. And then you see that yellow, which includes energy and food. So when you include energy and food, the volatility of the oil market due to the Iran war has just shot that back up over the last several months. If you look at the core CPI that removes energy and food, because those are always the two most volatile categories of prices going up and down, we've still stayed pretty solid on our inflation, but no doubt oil. And I think already, if when we see July's number, I think it's going to the at least the one that includes energy will turn back up as oil's gone back up the
Yeah.
last week or two. But again, this is why the government, specifically Trump, anytime you enter a war, there's tremendous social pressure to get oil down because it just ripples into so many avenues of the economy.
Mhm.
But this is where the inflation kind of comes from. You see fuel and oil up 42%, 12-month change. You see gas, energy, really the interest rates going down, the last 12 months. Median prices, that type of thing has actually contributed very positively to bringing inflation down. Sometimes we're the driver of inflation, sometimes we're the driver of that coming down. But really, we get fuel and oil under control, our CPI would look great.
Yeah.
Yeah.
And if you look at the rent growth and the owner's equivalent of rent that they post on the CPI,
Mhm.
it's not really actual because they're almost a year to a year and a half behind. And then
Yeah.
that's why I put the actuals in there because that's what we're seeing.
Yep, yep,
Right.
yep. Huh. Producer price index. This is just usually, a future of pricing when we go purchase goods and services, all that. So producer price index is up, which is a precursor that, prices might be going up a little bit too. This is PCE, the personal consumer expenditures. This is just how much stuff we're buying. This does exclude food and energy, but change from 1 month, 1 month to a year ago, up 3.1%. So, Gordon, this is saying that we're just spending a little bit more money right now.
Yeah, and well, and prices can go up. That depends on the price too. And this is the one that the Fed really looks at when they're looking at raising rates.
Yeah, because, yep. Average revolving consumer debt. Just up a little bit, but again, getting this down to when we're spending more money and our debt's going up, this just tells a story that we're just putting stuff on credit. And then federal debt right there, $39 trillion. A lot of debt.
Mm.
A lot of debt. And we were talking about yesterday, a lot of that debt that we have, a bunch of it's refinancing kind of over the next couple months, which is going to raise our interest payments in our federal budget over $1 trillion. And they're predicting now a $2 trillion deficit just in 2026, which is not great. We need to be paying down our debt, right?
Yeah.
Federal debt GDP floating around that 120%. And this also went down, Gordon. We were texting about this morning. Annual personal savings rate of disposable income. 2023, 2024, kind of healthier numbers, but we've dropped to 3.4%. As spending's up, credit's up, savings is down. We need to kind of get a few of those turned around. But deposits, average deposits at commercial banks is up 7.6%. So just the total deposit to banks. Gordon, what did you say yesterday? Why you theorized why
A
this
lot of
might
these
be?
IPOs that came out created an awful lot of cash the last couple months.
Yeah, giant
Mm.
cash out effect that then went into the bank account. Yeah, makes sense. Manufactured durable goods up a little bit, 6.2%. Purchasing Managers Index up 7.2%. And then a lot of these were red last quarter, Gordon, but just
Yeah.
manufacturing at a glance. So you look at new orders, employment, supplier deliveries, inventories, prices, backlogs, what, two-thirds just overall growing?
Yeah.
Um,
Unfortunately, the inventories are still too slow.
yeah.
Mm.
Retail, advanced retail sales up a little bit. U.S. consumer sentiment average has been decreasing. Utah index still always high. We're always optimistic here in Utah, but still way more up than 2022, but 75 on the index of consumer sentiment. Overall, just kind of a downward trend in the nation. And let's just try and hit Utah's economy. Just a couple highlights. Again, non-farm employment grew, which is great. That's just a robust economy. We've added 26,000 jobs. Unemployment actually went down to 3.6 versus 4.2. Just Utah continues to outperform the U.S. on job growth, unemployment, and just supporting long-term housing demands. But let's jump into some of these. You can just see the economic impact that the real estate industry has to that state's GDP. So all the homes that we're selling, what percent of that GDP is real estate? And we're 21.9. So we tend to be on the higher side. You see a lot of 13s, 14s, 15%. So just all you realtors out there doing a fantastic job contributing to the economy of the governor. We should get some awards, Mike. 20%? Sheesh.
I agree. I agree. Yep.
Utah keeps winning awards, but again, tied for the fifth highest annual employment growth. We have the high labor force participation at 67%. We're tied 19th lowest for unemployment at 3.7. We're still the youngest. We still have the most babies, largest household size. We have a very low poverty rate. We have a high purchasing power just with our adjusted household income. And I think we're the best looking, Mike. Best
I'd
looking.
agree with that, Johnny. Yep.
Population growth. So this is over the next 40 years, we're going to add 2 million people all crammed onto I-15 because we only have one freeway here in Utah County. But you see where they're all going. Utah County, 832,000 new residents over the next 40 years. Salt Lake, Davis, Weber. So put your fishing poles in the pond and go sell all those people houses.
Yep.
And then just Utah industry growth. Again, you see trade, transportation, utility, healthcare, social assistance, all those major growing industries, utilities, wholesale, even the rental leasing kind of shrunk a little bit. Yearly unemployment, you can see Utah 3.8%. Talked about that. But then here's the percent change in annual GDP growth. So we tend to lead again the 2.5 to 4.5% increase categories, that dark blue. So it's us. California's still growing. New Mexico, Louisiana surprised me. But you see even Texas kind of on the lower side down there where home of KW is. GDP growing, GDP. We talked about a bunch about this. Personal income growth, pretty much right on par with the United States, 3.2 and 3.4. But then construction, let's hit construction for some of our great agents that represent builders. Starter homes. Starter homes are making a comeback. New single family homes that are under 1,400 square feet. You're starting to see them finally the last 3, 4 years. We're building more of them which is good. You might see some of the tiny home movement. Mike, we were even talking about in that last bill that was passed, there was some legislation that on manufactured homes. It's always been hard to get manufactured homes
Hmm.
financed, but they're starting to move down the road of actually qualifying manufactured homes for FHA, for government endorsed
Yeah.
loans. So I think that actually could be a big boom for the manufactured home industry as those are getting better and better. But then just U.S. new family, single family home starts, again, down a little bit, down 5.6%. And then Utah residential housing starts. If you just look at the orange residential building permits, kind of right on line with where we were last year. But overall, total building permits slightly up 3%. And then just Utah housing needs. So this is by 2030, the latest estimate from the Kempsey Gardner Policy Institute. This is 153,000 homes. We need 153,000 homes more to meet our demand by 2030. So you see primarily where those are going: Utah, Salt Lake, Davis, but even Washington County. And then just the housing supply gap. We were really cutting into this post,
Wow.
COVID. Started getting that $50,000 number down to the 20s, barely touched 29,000, and then we've just gone backwards. So forecast to end the year is 44,000 homes short by the end of this year, as just we've had a little less homes coming on the market. High construction costs, limited developable land, infrastructure constraints, regulatory delays. Some cities are slowing down, not speeding up. Those all are the makeup of just why we continue to have a little bit worse of a housing supply. And then residential housing starts just in billions. Price index just showing us that prices still just barely trickling up, forecast. But builder confidence, it's not record lows of recession, but still right around that 36 on the index. But we've gone backwards a little bit, primarily probably because of the costs associated with that, but down
Yeah.
7%. But there's your monthly. But then I think last category, total debt just going up. Total household debt. You've seen kind of the student loan debt category go up. Credit cards expanded a little bit, autos expanded a little bit, but the primary one's just mortgages, which obviously prices going up could affect that as well. And the mortgage originations, just kind of consistent the last several quarters. Look at all those mortgage originations in post-COVID, just tons of just the 760, the good credit scores out there buying up stuff. Here's your auto loan originations, total debt balance of derogatory or delinquency status, the red, kind of consistent the last several quarters. Percent of 90-day delinquent by loan type. You're seeing credit card delinquencies go up like crazy the last 2, 3 years. Student loans, a lot of that's legislative driven, just that big spike up there. But autos starting to trickle up a little bit. But just again, mortgage, HELOC is our very lowest delinquent state.
That's what I was referring to earlier. It's cheaper
Yeah.
for them to pay their mortgage than it is to rent. So those are just going to
Low.
remain steady because we've got so
Yeah.
much equity out there.
Mm-hmm. Yep. Number of consumers with new foreclosures, again, low. Third-party collections, average collection amount per person.
Thank goodness has gone down a little.
Yep.
Yep.
All right. Well, that's it. My two expert co-hosts. Final thoughts, Mike.
That's all pretty good news. I mean, for the most part, we're doing pretty good in Utah. We got, as agents, I think we have pricing challenges and just we can all just get better at it, myself included. But people are still buying and selling homes.
Yep.
You
Yep.
know, there's business out there. I think just in general, we need to probably talk to more people than we were used to. And so I appreciate you having me on. It's been great. I've learned a lot today, and it's good. Could it be better? Yeah, but it sure could be a lot worse.
Yeah.
It
Yeah.
could be a lot worse.
Gordon, any final thoughts?
Just it's good to see the consistency. We've always been very conservative here in the state. And I think that reflects how steady everything is.
Yeah.
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 There's parts of the country that are not as steady as we are, and they're having a lot of problems.
Yeah.
Yep. Yep.
Very true.
Well, great. Well, thank you all for being on the call. No major surprises this quarter, so we'll look forward to next quarter, see what happens. We'll see what headlines hit the news sources out there. But we always appreciate sharing all this data. And again, you can find it on kwutah.com or kwutah.tv. So have a fantastic last 2 days of the month, and let's roll into August, everybody. Thank you.
See you.